But dude, when you're 63 years old, when you start withdrawing, you're going to start paying taxes at that point.
Yeah, you're right. 401k withdrawals are taxes in.
Exactly.
You're going to share that with us. Wow, you don't have the secret sauce to private equity, okay? He's assuming that everyone just has millions of real estate. Great news, this guy's going to give you the key to how to 10x your money. I'm Rob Tetrault, and we are back for another reaction video. This is my first initial reaction to the financial advice and the financial experts that are talking to you on TikTok. Here we go.
A lot of money in my 401k.
Okay, I'm sorry for you.
Why do you feel sorry for him? It's a way to put money in without paying taxes on it.
It's a way for you to be trapped for 30 years.
Well, you can pull it out when you're
63. How old are you right now?
50.
13 years from now, will taxes be higher or lower?
Higher.
You will wish you would have sold them when you were 50 because you'd pay lower taxes, dude.
You don't pay any taxes when you pull out money out of your 401k if you wait until you're 63.
When you start using that money, you're going to pay taxes, bro. You weren't charged taxes while it sat there. What's wrong with you?
IRS allows penalty-free withdrawals from retirement accounts after the age of 59 and a half.
Penalty-free, not tax-free. So they're going to charge you a penalty. They're going to put handcuffs on you to sell it before then. But dude, when you're 63 years old, when you start withdrawing, you're going to start paying taxes at that point.
Yeah, you're right. 401k withdrawals are taxes in.
Exactly.
So Grant, you're extremely wealthy and you've done well for yourself. You're in the 1%, but come on, most people are not. Most people are working hard to save what they can. They acquire whatever they can. They're putting 10 or 20% of their paycheck away every month. And the best use of those funds is always going to be a combination of registered assets, 401k or RSP, TFSA for liquidity. And that's a fact. You get the huge benefit from the RSP, the tax-free compound growth. You will be in the best shape in retirement if you properly use your RRSP. And that means contributing in your max earning income years, making sure you max contribute in years where you can, accumulating that room, saving it for the optimal time, and making sure you have some assets in your TFSA. All the assumptions you're making in here, Grant, you're better off keeping it for yourself. You're making assumptions that people have infinite amount of capital. They don't. They're saving what they can, and that money needs to go towards their retirement. And people who are saving money, accumulating wealth, their best option is to do it through a 401k and an RSP, and that's a fact. You're wrong, Grant. He's flat out wrong.
I borrow money, guess what? Do I pay taxes on debt?
I guess no.
Why is that? Why is debt tax-free?
I don't know.
Because that's how money is created. And so the banks love it. They love people who borrow lots of money. So how do I get rich? I borrow money and I buy assets with it. The poor person borrows money and buys liabilities like purses, cars, houses, and they get poorer and poorer and poorer.
So I actually like this comment. I love what he's saying here. I love that he's saying that there's two different ways that people live off of their debt. One of the things that people do is create bad debt, which is liabilities, non-essentials. You're borrowing funds to increase your balance sheet as a company would. If you're treating your household as a company to increase your balance sheet, leveraging yourself to purchase another asset, which you hope will appreciate in value, like a home or a rental property or a condo, that is good debt. That is very good debt. If you're borrowing funds to pay for a Lambo or to pay for a trip to Europe, that's less good debt. I'm a big believer, a big proponent that healthy debt will help you in your retirement today. So by leveraging the right way today with assets and by minimizing liabilities that are not helping your balance sheet, that's how you improve your retirement lifestyle.
Here's the tact you have to do. Get a credit card, one credit card, okay? Spend about $50 a month on it. You don't need to spend any more than that. And then pay it off. Make sure you pay it off on time every month, month after month. The algorithms that look at you increase your credit score regardless of how much you're paying off. So you don't have to put thousands on it. The fact that you pay it off gets you a higher score immediately. This is the trick you have to do. It's a hack. That's what I call it. Right out of college, get a card, don't abuse it, pay it off every month. Any small amount works. Bingo, you get a new credit card. Another great vampire tip.
Thanks, Kevin Dracula O'Leary. You're touching on a good point here. Definitely a good way to raise your credit scores to pay it off. He's talking about the percentage of the debt that you pay off every month. So that's, if you have a $50,000 credit card and you use all of it, then they're going to look at that as a high debt usage score. If you have a $50,000 limit credit card, you use 50 bucks of it and you pay it off every month, yes, that'll help your score. Now, a better way to help your score is to never miss payments, always pay your mortgages, pay all your bills on time. But this is definitely one of the ways to raise your credit score. Further to that, if ever you get in a position where you can't pay off your credit card in full, cut the card. You spend $2,000, you can't pay the $2,000 that month, cut the card, pay it down over time, and wait till you're ready enough to have a card again. Credit card is major responsibilities and people often forget it's real debt that gets away from you. At 20% interest rate, it catches up real fast.
If you are broke, you should not be investing in stocks and real estate. Stocks and real estate is the slowest way to get rich unless you are trading or flipping houses. But if you are working a job and you're trying to find a way to get rich, investing in stocks and real estate will never do it for you because it's going to be way too slow and you're not going to get rich until you're 40. You need to be investing your money into learning skills that will help you make more money. Because once you start to make $100,000 a year or $200,000 a year, then you can start to invest in stocks and real estate. And that's when you'll start to see some returns that you could live off of.
Interesting take. I definitely agree that you should invest in yourself first and foremost. So I'm a big believer in education, programming, to learn a trade, learn how to run a business. All of those things are things you should be doing. Once you've got to the point where you're accumulating wealth, you need to be investing in stocks and real estate. That's the absolute only way to get rich, is to invest in stocks and real estate once you're saving, once you're in the accumulation phase of your wealth. Before you get to the accumulation phase, absolutely rack up some student loan debt, go take some degrees, go learn some trades, build yourself a business, do what you need. But once you're accumulating wealth, 20% of each paycheck, whatever you're able to do, put it away. Long-term, large cap stocks, real estate, alternative assets, that's the way you get rich.
The stock market does not build you a 28,000 square foot addition on your home. 401ks, IRAs, they are all lies. They're all low single-digit returns. And at best in the next 20 years, they're going to triple, which means when you get to retirement, you're not going to have what you want. But if you study family offices, if you study how wealthy people become wealthier, they're investing in something called private equity. They're taking a look at companies like Tesla and Uber before they shot up really big, and they're investing them before they 10x, 50x, and 100x or more. Well, every year I find 10 of those companies. And on February 20th, I'm going to share with you who they are, where I'm putting my money, where I'm expecting some of my biggest growth, some of my biggest gains, and how I mitigate my risks. If you want to know how I do.
Great news. This guy's going to give you the key to how to 10x your money. In reality, guys, yes, private equity is one of the ways that people use to enhance their wealth, but it's one asset class, okay? Do not go put all your wealth into one unlisted private company that your buddy knows, a friend of a friend, and promises of 50 times your money. That doesn't happen, all right? It doesn't happen. Most people go bankrupt, belly up, lose everything way before they're able to save $1. The best way to use private equity is to complement an investing strategy of stocks, private real estate, alternative assets. Private equity can fit inside of that, whether it's 5% or 10% of your overall asset allocation. That's what you should be using private equity for. Don't use private equity as a shortcut to your retirement. Use it as a complement to a healthy retirement lifestyle. So I am a real portfolio manager, guys. I manage over $1 billion in assets for families, retirees, wealthy Canadians. This is what we do. So if you're looking for advice or if you want tips and pointers on how to do some of this stuff, you're looking for your own portfolio manager, go to speaktorob.com to book your no obligation consultation. I'd love to chat with you. Thanks for tuning in, guys. I'm Rob Tetrault. I'll see you in the next video.